Good afternoon, everyone. Thank you for joining. We've my IT team has told me that we've got a great deal of attendees for today's webinar. So thank you so much for taking the time out of your busy day to have a chat with us and discuss, a couple of the stocks that we're taking a look at, particularly now in this quite tumultuous market environment. A lot of questions have been raised, of course, where to actually invest. Just today, I'm sure you've all seen the market's currently down another 2%. Off the back of a lot of negative sentiment coming out of the US financial markets in particular. So we're going to touch on that a little bit today. My name is Marcos, as usual. Thank you again for joining. And we'll just pop off to the next slide here. As of course, with all of our webinars, all the advice that we provide here is just general advice only. If you do require any sort of personal financial advice, please, you can also feel free to recruit us. But at a first step, please go see your personal financial advisor or broker. So just hitting onto the agenda for today, we're going to take a look at the market movers, what's been happening over the course of the last couple of weeks. A lot of interesting news coming out of the US, particularly, as I mentioned before. What we're looking at in 3 of our top stocks, how to actually mitigate this rising inflationary environment. This what we call the reserve banks of the world have tried to pull this inflation as what they call transitory. How it's essentially transitioning into a smaller state. However, we've seen in the last recent CPI results coming out of Australia in particular and of the US, while it is slightly slowing, there are another few concerns that make it seem like it's a bit more of a sticky situation. Something will be possibly going on for the next 6 to 12 months. So we'll touch on that a little bit as well. And then we're going to look at our portfolios, see how they're going, seeing how we rebalance and what we did and how we're achieving our result. So first step, obviously, the market volatility. I'm sure a lot of our clients and a lot of our members looking at this webinar currently taking a look at the Silicon Valley Bank collapse. It's not well, it was purported as the second biggest US bank fail in history. Of course, number one would be Lehman Brothers. However, Silicon Valley Bank is not your really traditional bank. It's essentially a venture capitalist bank that provides private equity to a lot of technology companies that are based in Silicon Valley in San Francisco, obviously, as the name suggests. But a lot of these venture capitalist investments were also triggered to a lot of tech companies, a lot of crypto funds as well. And that, unfortunately, with the profit losses that they reported, induced a bank run, which is not something that you want to see, particularly in the supposed strongest economy in the world, particularly when it comes to the financial system. And that's really rocked it for the entire financial system internationally, not just, of course, in the US, but currently here in Australia as well, and over in Europe, particularly as well. So you can see here, just on the next slide. Yeah, so the Reserve Bank, I mentioned this a couple of weeks ago, which was pretty much as expected. The Reserve Bank raised interest rates back to 3.6%. That's obviously the highest level in 10 years, the 10th consecutive interest rate hike coming out of the RBA. And look, overall, very similar story to what's coming out of the US. And I've mentioned this a couple of times, but essentially the monetary policy coming out of the RBA is something that probably needs to be adjusted. And there was a bit of a dovish stance coming out of Philip Lowe's speech that he provided. I think it was an AFR business event the morning after the RBA rate decision, basically purporting that there is a possibility of taking a pause coming into next month in April, but that will of course depend on the CPI figures coming out. So CPI currently domestically in Australia did reduce. The headline inflation rate is still about 7.8%, but month on month for the month of February was about 7%. So it has slightly reduced. However, there are still a couple of headwinds coming out of this inflationary figures, because out of those numbers, the real estate market hasn't dropped as much as what was actually expected, which was quite surprising. However, core inflation, which of course takes out cyclical factors such as energy and things like that. Taking a look at that in particular, of course, because that's what's affecting the vast majority of individual consumers today, particularly groceries, consumer staples, all those sorts of things. So that is still not at not at a good level. So the target rate of inflation for the RBA is still sitting around that 2-3%, and very similar aggressive tones coming out of the RBA towards, similar to what the US Federal Reserve is doing. The US economy in particular, it's actually, the inflation rate is actually lower than ours. It's about 6%, which is interesting. So we've taken a bit more of a dovish stance. However, the US Federal Reserve, particularly with their monetary policy and how they're utilizing a lot of their bond payments as well, has really affected the financial services industry. Selling about a couple of $1 trillion worth of bonds on the bond market. The bond market is, as you would expect, somewhat more of a safer haven. However, in recent months, it's actually been quite as volatile as the equity market, which is something definitely to take a look at. And that's, of course, had flow-through impacts onto the financial industry as a whole, which is quite interesting. Yeah, so you can see here, as I mentioned, just after that SVB collapse, Silicon Valley Bank collapse, a lot of the financial sectors were hurt over in the US, and then as soon as that event happened, of course, we, as a bit of a follow-through index, as we are, as the ASX tends to be, the financial sector dropped quite a bit. So I'm sure you noticed a lot of our investors, which is quite something that we've reported for quite a long time. Say, for example, with CBA, which was trading at all-time highs. You can see here on the next slide. Yeah, so you can see here on the next slide there, where we mentioned a few weeks ago, essentially, that a lot of the markets was focusing and transitioning a lot of their capital, a lot of their free cash flow into the top 10 stocks on the ASX, which for any seasoned investor will know, outside of CSL there, are particularly miners, BHP, Fortescue, Rio, and of course our big four banks, and Telstra in there as well. Those are your top 10s. Okay. We saw those trade at pretty much very close to all-time highs in the last couple of weeks. However, those have come down quite significantly, which is what we mentioned a few webinars ago, which was not necessarily sustainable, particularly Commonwealth Bank, which we've had, for our members in particular, we've told them to reduce, particularly on CBA, when it was particularly trading at about $111 per share. I think it's currently trading about $93 per share, and these are the little things that do have a maintenance effect, particularly within the financial sector. Domestically as well, a lot of the big four banks have continued to face ASIC inquiries, particularly around fees that they've been charging, I should say, for essentially non-services. A lot of these big four banks have been paying these fines, of course, to keep it a bit under the table. So it's not fantastic. You can see there over the 1 month, CBA has gone down about 13%. NAB and Westpac following suit, about 10% down as well. All right, so what do we pick? What exactly do we go through in these very, very uncertain times? Well, there are a few stocks that we are currently looking at, and we've mentioned it a couple of times as well with regards to dividend stability, right? Strong cash flows and purposeful business models going forward, right? You don't necessarily want to just be taking a particular stock just because of its name, right? So first one we've got under the radar is this next one, Bisalloy Steel, right? Literally, as if anyone who knows what Bisalloy Steel does, they're a manufacturer of high-strength tensile steel products, primarily used in mining and defense as well. I'm sure you've heard of the Bushmaster, the absolute legendary defense product that is created by Australia, of course. That tensile steel product is utilized and is provided by Bisalloy Steel. They've had quite a consistent long-term trajectory. And as well, of course, because of the geopolitical tensions going on in Eastern Europe as well, they've expanded their market share over there in Europe as well. So you can see here on the next slide, as I mentioned, right, very consistent revenue and EBITDA growth coming out since FY18, sitting there currently at about 25,000, essentially meaning 25 million, right? Very consistent growth, and volume by region is something that's actually quite interesting as well. So usually you can see there in FY20, Australia essentially was about 50% of capital total revenue, I should say. But the region that is actually taking the most interest, which is quite interesting, is also China as well. And as I mentioned before, they're expanding quite progressively into Europe as well. And you'll see that on the next slide. Beautiful. Yep. So primarily there as well, you know, the products you can see there on the bottom right hand side. The products actually go, of course, across the globe, South Korea, the Middle East, a bit of Eastern Europe, as I mentioned, Slovenia, Slovakia, and China as well, being, of course, the main purporter of that. So you can see there, they have a strong reputation for high quality, durable steel products, which is true. It's a very straightforward statement because it is the highest tensile strength steel that is produced currently in Australia. It's used by you know, your big giants such as BHP, Rio, for their tensile long lead items as well, which are used particularly for mining as well. So you can see there industry breakdown, I believe, that middle pie chart there. The mineral processing and mining actually incorporate well, close to 80% of their industry breakdown in terms of what they're actually selling the product for, which is pretty great. Right, that's what it's used for. But of course, they're looking at that little sort of segment of the pie chart to expand into defense as well. I think this next slide really shows pretty great partnerships. They've got quite an impressive portfolio. I'm sure you can see a lot of these companies you would know off the top of your head. You probably own a couple of them as well. You know, you've got Oz Minerals there, Newcrest Mining, Evolution, BHP, Yancoal right there in the middle. We've mentioned that one a couple of times, has done fantastically well despite the market having an absolute terrible few days, and of course Paladin there as well. So a lot of these stocks you'll notice, and of course you can see there in the bottom right a lot of Asian markets as well. All right, so very interesting and a great one to take a look at. And you can see here, despite the market turmoil, over the course of a 5-year period, sure, it's up 98%, but you can notice year to date from that 2023, it hasn't done significantly well, but we're currently reaching a bit of an inflection point when it comes to the technical analysis on this stock. It has been relatively oversold based on the RSI signatures that we've seen, and we currently have a target price, I believe, about $2.80 in the 6-month period for this one. And as I mentioned at the beginning of when talking about Bisalloy, they still have maintained a 7% dividend yield fully franked as well, which is quite of course useful, particularly when you're looking for stable dividend income stocks as well. All right, and then we'll pop off to the next one here. Newcrest Mining, right? This has been obviously our main sort of agenda for the last few weeks, and we've mentioned gold. We actually did a gold webinar a few weeks ago, I believe, as well, just when the gold price was just sort of starting to tick up. It was trading within that 1550 to 1750 per ounce range for quite a while, pretty much ever since it peaked last February during the Russia-Ukraine crisis at about 2100, and then it sort of just did a bit of a range trade. But now what we're seeing and what we've been, of course, telling our customers is to, of course, utilize that gold as an inflationary hedge, right? And that's worked quite well. Right, they've got that Newmont offer as well, particularly for Newcrest. But this is a general statement in terms of gold as a whole. Gold's currently trading about that 1925, I believe, US per ounce, which is huge, right? And that essentially means for tier one jurisdictions, tier one gold miners such as Newcrest, that have the capacity and the ability to generate very strong margins with that current gold price. Dividend yield of almost 2.1%, not bad for a gold miner. They're not really there for income dividend yields, but the dividend yield of 2.1% is nothing to laugh at either as well. So just a bit more on Newcrest. They've got quite a wide jurisdiction portfolio. You can see that they've got projects in South America and North America. Their primary projects, of course, are maintained within the Western Australia region and, of course, Australia. Right, but yeah, pretty strong overall. And they also have a couple of copper projects as well, which is pretty good for any of our copper investors out there. You can see on the next slide here, this is probably the half year 23 highlights. Yeah, that's the one. So about 1,039,000 ounces of gold production and 67 kilotons of copper production as well. But you can see those percentage changes, which is quite a big deal. 25% increase on gold production, 32% increase on copper production, and even bigger, right? We saw over the last 12 months the primary concern for a lot of miners, not just gold miners or copper miners or mineral earth miners or lithium miners or anyone, pretty much no one was, of course, not subject to the inflationary pressures that came over the last 12 months. We saw massive rises in all-in sustaining costs. However, Newcrest was quite a good one. They actually reduced their all-in sustaining costs to about $1,089 per ounce. So a minus of 8%, which is great, right? So you can see when the gold price is trading around that 1930 mark, that's essentially a 50% margin of what they can make per ounce of gold, which is fantastic. And what else can I mention here? Yeah, okay, yeah, that's, and look, statutory profit about 300 million, pretty good. And the early repayment, they essentially had a credit facility from London Gold, not London, England, but London Gold. They were able to repay that debt facility of 173 million based on their profit margins that they made over the last half year, which is pretty fantastic. All right, particularly in a rising interest rate environment, having that debt load essentially has gone from a couple of percentage points of interest to upwards of about 8-9%, depending on the corporate facility that they introduced, is a massive increase on debt that they have to pay. And you can see there, point number 3, interim dividend, US denomination of 15 cents, and they paid a special dividend of 20 US cents per share, based of course on those increasing margins and those lowering of costs, which is great. So a total of 35 cents per share, not bad. And they've got, you can see on the next slide here, I'm not going to dwell too much on this stuff, but essentially they've received a major strategic milestone from their Cadia asset, cementing its position as a leading gold miner. Yeah, look, it's definitely accurate. That's how you attract possible takeover offers from the biggest gold miner in the world, which was Newmont. That's still obviously a little bit of a mystery at the current moment, seeing how they're doing their due diligence. However, going forward, Newmont will still, and they have of course had previous takeover offers as well. So that is something that we're looking at quite closely as well for our members. And you can see here on the next slide, pretty good. Newcrest Mining has achieved about 19%, 18.7% in particular, year to date. That's probably a little bit high today because the only stocks that are going up today are gold stocks. So that's probably a little bit higher. But you can see this is essentially the relevance, despite, of course, trading previously at about that $27, $28 mark. They, of course, had that a little bit of a hemorrhage coming into last year, of course, doing that range trading of the gold price, but now we're seeing that uptick, and that's exactly right at that bottom there. That's exactly where we got our members, back into gold miners such as Newcrest, Northern Star as well. All fantastic, especially in a highly uncertain environment. Hopefully that all made sense. If you have any questions, of course, feel free to send your questions through to my IT team here that are managing the webinar. We'll be happy to handle those. The last stock we're going to talk about, bit of an interesting one, Codan. The first question you're going to ask me, of course, Marcos, what are you doing recommending tech stocks in a bear market? Yeah, I know. But Codan has done, obviously, over the last 12 months when tech stocks have been quite horrendously damaged. We've seen companies like ZipPay go from about $8 to about 47 cents. EML, Sezzle, all these tech companies who maintain on a particular performance portfolio and with a relatively significant debt burden, not performed well. However, Codan hasn't done too badly. They of course suffered from negative sector sentiment over the last 12 months. Over the last year, they of course haven't done well. But you can see here, just year to date, starting from, of course, January 23, gone up almost 30%. That'll be a little bit lower today. As I mentioned, I did I did those charts yesterday, but today it'll be slightly lower, but still 25% capital growth currently. Just year to date in the first few months of the year. Dividend yield has been maintained close to that 5% mark, particularly in the communication industry. Right, Codan manages a lot of military communication devices as well, and social devices as well, which we'll go into a little bit later. So you can see here the return to earnings growth. The first half, 2023, FY23 was about 211 million, right? Revenue was down from the previous corresponding period, fair enough. However, that's relatively stable compared to a lot of the other tech stocks that have generated revenue, right? But the communications segment, which I mentioned before, the metal detection segment is also one of their prime revenue sectors. However, the communication sector has increased 16%, right? And this is not too dissimilar to what we were talking about with regards to Bisalloy Steel. Bisalloy Steel is focusing on that defense network, and the communication segment of Codan's technology is actually quite useful. It's high quality and is quite reliable as well. So that's why it's used via the government and a lot of military contracts as well, which is quite interesting. So you can see here as well, approximately 11% of revenue, right, in the metal detections and communication, right? But the engineering spend for the first half of FY23 has actually been maintained relatively well. So that's quite a good thing to look at, particularly with inflation being so high. All right, the only one I really want to touch on there. Yep. And of course, they've got a few different sectors as well. Particularly with MindLab. MindLab's actually quite a popular product, not just with commercial or wholesale suppliers or businesses, but they're actually pretty fun if you want to go looking for treasure detectors. Essentially, they're very high quality. If you're living out there in regional Australia, looking for a bit of gold or a little bit of rare earths, that would definitely be the one. They obviously haven't been expanding to quite a few retail markets as well. And of course, the communications sector as well. Just a little bit last one on the price action. As I mentioned, very similar growth trajectory, right? You can see over the last 12 months, not too fantastic, right? But since the start of 2023, right, a little bit of that tech sector sentiment and essentially what that means and what that is doing. The tech sector, of course, has been hemorrhaging for quite some time over the last 12 to 24 months. But now we're in a state of a recycle where investors and traders are looking at technology stocks that are still generating quite a substantial amount of revenue, low PE, and maintaining their costs and their debt. Right, Codan is one of those, and you can see that almost doing 30% year to date, which is pretty great. All right. I'm just going to touch a little bit on our portfolios as well, just for anyone who's interested. So you can see here our income portfolio, right, of course, is primarily towards generating a high dividend yield. Our top picks, right? I'm not going to tell you what the top picks are because that's only for our members. But our top pick, 18.5% so far year to date, right? And there are stocks there, of course, as you can see. It's not necessarily all buys, right? This is the service that's essentially attributed to people who come on board and taking a look at not just when to buy, but particularly in a market like this, when to take profit, when to sell, etc. Our next one's our growth portfolio. That one's a cracker. That's a little bit of our hidden gem there for our members. That our top selection on the growth portfolio when we recommended it back then has done about 74% year to date so far. Next one, mining portfolio. Usually our mining portfolio is actually something that's probably, it has been our best performer for the last few years. However, our mining portfolio has still done relatively well, particularly with inclusive of dividends. These results are also non-inclusive of dividends. So if you're looking for a high yield dividend portfolio, that's of course something that we manage as well. Great. All right. So yeah, I mentioned this a couple of times, but that's exactly, essentially our trajectory of how we identify stocks. We identify them early, right? No one's going to, of course, now I'm sure you'll see at least half a dozen other webinars telling you to buy gold stocks and telling you to buy this, stay away from tech, stay away from that. We were saying this for quite some time, right? That's the purpose of the analysis. You have to be ahead of the market, right? That's essentially being a successful investor, is by being someone who identifies something early and is able to act on it as well. All right, and I'll touch on the last couple of things, how to invest, right? I've mentioned this throughout the webinar today, right? Focusing on healthcare and consumer goods being consumer staples, not consumer discretionary. Not saying that there aren't any good consumer discretionary stocks out there. Of course there are plenty. However, in the current market, you won't be taking a ride on them at the current moment. Consumer staples still maintaining quite well. We mentioned quite a few healthcare stocks as well over the last couple of months, which were a little bit downbeaten over the last over 2022, but have performed quite well as well. And again, as I mentioned, the dividend stability, right? Dividend stability is huge. Okay, it's massively huge. A lot of investors, right, they'll be focusing, of course, on their income yield to supplement their retirement, focusing on stocks like Fortescue or BHP, Rio, right? Even those stocks are subject to change. BHP and Rio and Fortescue all cut their dividends on average about 30% over the course of the last first half of the financial year, right? Still not horrible. BHP is still currently trading, I think, about a 9% dividend yield, which is still pretty good, right? But the forward forecast and the actual dividend stability that they're able to implement is something that is huge, okay? Particularly for a lot of our investors who are SMSF clients or they're managing their own portfolios. Having that dividend stability is huge, okay? And last one, of course, right, base metals, precious metals. Precious metals have also had an absolute shocker over the last few months, but that's okay because that stability that we're looking for is particularly coming out of that growth demand in China, right? We've seen iron ore prices as well reach about 130 USD per ton. Fantastic indicator, right? There, of course, is a bit of a cyclical nature to the market, of course. The financial debacle that the US has obviously occurred is not helpful to anybody, but the increasing Chinese demand is still apparent, right? Essentially, the increasing iron ore demand and the increasing iron ore price is essentially about a proxy of how the Chinese economy is faring. So we're looking at that, particularly in base metals and precious metals coming out of that demand. Okay. All right. So thank you very much, everybody, for joining. Appreciate, again, taking the time. My IT departments are really happy with the amount of web members we've had come onto the webinar. So thank you again for taking the time. If you've got any questions, feel free to give us an email or give us a call, and one of our equity specialists will be in touch. But thank you again for joining. Thank you much for your time, and I hope you enjoy the rest of your day. Thank you, everyone.